In this video, we're going to be discussing manufacturing overhead variances. There are two main types. There's a spending variance, which relates to a difference in price, and then there is an efficiency or a volume variance, which relates to a difference in quantity. Separate variances are going to be calculated for fixed overhead and for variable overhead. And while the process is the same for this, the titles are slightly different. Both have a spending variance, but for variable overhead, the quantity variance relates to efficiency, and for fixed overhead, the quantity variance is called a volume variance. Just as with all of the other variances we've discussed, there are two possible results. If there's a negative variance, it's favorable because it means that a company has spent less or used less of something. And if there is a positive variance, it's unfavorable because it means that more than expected was spent or used. As mentioned in the previous slide, there is a spending variance, and this relates to the amount of money spent on the overhead. As you know by now from other lectures, companies keep a manufacturing overhead account, and they put actual expenses in as debits, and then they apply it and take it out and post the expenses to WIP based on an estimate. They pick some kind of a cost driver that closely approximates how manufacturing overhead would go out the door and should be applied to WIP. Sometimes it's machine hours, sometimes it's direct labor hours, sometimes it's something else. But in order to apply the overhead, the companies will take whatever the cost driver is, the machine hours, for example, and they will multiply it by an estimated manufacturing overhead rate. And that is how they make the allocation. As you remember from job order costing conversations, the estimates almost never match the actual, and so a company is almost always either underapplied or overapplied at the end of a period. This underapplication or overapplication is the same thing as the spending variance, assuming that you were breaking the variances down into fixed and variable components and keeping those in separate T accounts. Now, in reality, you won't keep them in separate T accounts, but if you were, the under-application would equate to an unfavorable variance because essentially what's happened is you would have incurred more manufacturing overhead than you had anticipated, and you would have a positive balance remaining in the account. Well, that's under-applied, and as we know, positive variances are unfavorable. If at the end of the period you had over-applied your manufacturing overhead account, this would equate to a favorable variance because you had fewer manufacturing overhead costs than you had anticipated and applied. So, in a nutshell, the spending variance is just the difference between the actual manufacturing overhead that a company incurs and the overhead applied. Now remember, you do have to break that out for variable and for fixed, but the concept remains the same. On the other side of our upside-down pyramid, we have the efficiency variance or the volume variance, depending on whether you're calculating variable or fixed variances. Essentially, this is just due to a change in the quantity of the cost driver. You take your actual quantity and subtract out your budgeted quantity, and then you multiply it by the amount assigned per cost driver unit, and that gives you your overall variance. We're going to see an example of this here in just a moment. This is what the upside-down pyramid would look like for our variances. You're going to take your actual quantity times your actual price to get your first set of numbers. Then you take your actual quantity times your standard price to get your second set of numbers. And then you take your standard quantity times your standard price to get your third set of numbers. Often in problems that you'll see for the CPA exam, the sum of this will just be given to you because actual quantity times actual price represents the total that was actually spent by the company. And so if you're given an overall total at the end of a period, you can just put that number in. It doesn't matter what these two numbers are for the first subset. This is a structure that you're used to seeing when we calculate materials and labor variances. It's exactly the same for manufacturing overhead. The first two subsets create your spending variance because the thing that's different in the subsets is the price. Your first subset has actual quantity times actual price. The second one still has actual quantity, but this time times standard price. So any difference that's going to result is going to result as a result of the change in price. You either spent more or less than you anticipated in total on manufacturing overhead. And then this second variance, the efficiency or volume variance, is going to be due to a change in quantity, usually a quantity in the cost driver that you used. You may have anticipated that you were going to use 10 hours per unit and you actually used 7 hours per unit. That's something that drives this variance, because you'll notice that the price is the same. And so this subset is actual quantity times standard price. This subset is standard quantity times standard price. The difference in the two has to be due to a difference in usage. And then if you needed the total overhead variance, just as with our other variances, you would add your two subvariances together. Let's take a look at a couple of examples here. In this first example, we're going to look at variable overhead variances. So in this problem, it says variable overhead is applied at the rate of $4 per machine hour. The use of 10 machine hours is budgeted per unit produced. The planned and actual output was 90 units. The actual number of hours used was 980. The actual variable overhead was $3,000. Calculate the variable overhead variances. So I'm just going to read back through the problem and plug everything in where it goes. So variable overhead is applied at the rate of $4 per machine hour. That's our standard price, and it goes in two different places. It goes in that first subset and the second subset. Then it says the use of 10 machine hours is budgeted per unit produced. So that's going to be the standard quantity of hours that we use for each number of unit, or for each unit that we produce. But we need to know the number of units before we can get to our total standard quantity. It says the planned and actual output was 90 units. So the number of units made multiplied by the standard hours per unit gives us our standard quantity. So we put 90 times 10 there under the standard quantity, or 900. Then it says the actual number of hours used was 980. That's going to be our actual quantity. And I'm going to plug that into the second subset. There is a space for it under the first subset, but we end up not needing it because it says the actual variable overhead was $3,000. So I'm just going to plug that final total in down there. Then it says calculate the variable overhead variances. Well, we already know the number for the first subset. The second subset will be 980 times 4, so 3,920. The third subset is our standard quantity times our standard price, 3,600. Then, to calculate our variances, we just subtract from left to right. So 3,000 minus 3,920 gives us a negative 920, which is favorable for the spending variance. We spent $920 less than we thought that we would spend on manufacturing overhead. And then the efficiency or volume variance is calculated by subtracting the 3,600 from the 3,920. And because we are subtracting from left to right, we end up with a $280 unfavorable variance for the efficiency. And the reason for this is that we ended up using more hours than we thought that we would use. We anticipated that to make 90 units, we would use 900 hours, right? Because 10 hours per unit times 90 units should be 900, right? But we actually used 980. So since we used more hours than anticipated, that led to an unfavorable variance. If we wanted to know what our total variable overhead variance was, we would then add those two subvariances, negative 920 plus positive 280. We end up with negative 640, a favorable total variable overhead variance. Then we'll go into the second example. So in this example, it says fixed overhead is applied at the rate of $1.60 per machine hour. The use of 10 machine hours is budgeted per unit produced. The planned and actual output was 90 units. The actual number of hours used was 980. The actual fixed overhead was $1,500. Calculate the fixed overhead variances. So we're going to go through the same process that we did earlier. Going back through the problem, it says fixed overhead is applied at the rate of $1.60 per machine hour. That is my standard price, and I plug it in the second subset and the third subset. Then it says the use of 10 machine hours is budgeted per unit produced. That's going to be part of my standard quantity, but we need more information. And then it says the planned and actual output was 90 units. That's the other piece of information I need. My standard quantity would be the number of units that I produced times the estimated number of machine hours per unit. So 90 times 10. Then it says the actual number of hours used was 980. Just as before, it could go in that first subset because there is a space for it, but when you read the next line, it just gives you the total for that whole first subset. It says the actual fixed overhead was $1,500. So I'm able to plug in that total. I don't need to do the calculation. Then it says calculate the fixed overhead variances. I know the number for my first subset. My second subset is the actual quantity times the standard price, 980 times 160, and that gives me $1,568. And then my third subset is standard quantity of 900 times standard price of $1.60. And when I make that calculation, I get 1,440. Then to get my spending variance, I just take my number on the left, subtract out the number on the right, and I get a negative 68, or a $68 favorable spending variance. I didn't have as much in fixed manufacturing overhead cost as I had allocated. And then to get my volume variance, I again take the number on the left, subtract out the number on the right. This time I have a $280 unfavorable variance because I actually used more time than I anticipated that I would in machining the products. So then if I wanted to calculate my total fixed overhead variance, I would just add those two variances together, negative 68 plus 280. And I end up with a variance of 212. It's positive, so it is unfavorable. And that is it for manufacturing overhead variances. If you have any questions, please let me know in class.